Okay, we are recording. And the only reason I say that is because if you ask a question, it'll be on the recording. I may also repeat your question because I'm not sure how well the mics pick up things out there. So at any rate, what I want to do just to start off with is go through the material we've covered since the last exam, which is going to be 4 categories. It's going to be investments, long-term liability, shareholders' equity, and then the operating ratio analysis we did yesterday. So I'm going to cover some material. Please interrupt me if you have questions as we go through it. Once we finish that, and I have no idea how long it's going to take, I imagine right around an hour or so. If you have any questions you'd like to ask after that, please feel free to do so, okay? So let me just start off with the kind of 5 transaction chart that we talked about the very first time I met you all in room 190. Remember, we have 2 places where we get capital. Where are those 2 places? Lenders and shareholders, okay? So we get capital from lenders, and we get capital from shareholders. Then we take that capital, and the next step is we're going to invest this capital in what we call productive assets. Once we've done that, so Walmart shareholders have bought their stock, Walmart has gotten money from lenders, maybe from banks, but maybe from issuing some bonds to bondholders. They go out, they're going to build stores, they're going to furnish the stores with shelves, with cash registers, they're going to have delivery centers and trucks and all their property, plant, and equipment. We then are in position to provide products and services. Remember, we hope we can sell those products and services for a profit. Some of that profit we invest back into the company. And when we talk about property, plant, and equipment, we talked about, are they reinvesting back into their property, plant, and equipment? Some of those products and services we're going to be putting into, I have cash here, but we can think of that as being cash-like stuff. It's things we want to keep our money. We want to keep it for flexibility. We want to keep it for potential acquisitions, maybe making additional capital expenditures. We want to earn a decent return on it. And what we're then going to do is to provide a return to our shareholders and a return to our lenders. And where we really focused since the last exam, we talked about a different type of investing activity, and that's just going to be taking this idle cash that otherwise would be sitting in a bank, and investing it in either debt or equity securities. So we have investments, which will be the first topic we covered. We're just going to cover these in the order that we did them in class. Then we talked about where companies go out into the market and issue debt, publicly traded debt. And that's where we're going to talk about bonds. Then we talked about what happens when companies issue stock. So we talked about shareholders' equity. And then the one thing that kind of spans all of this stuff, when we distinguish between an operating asset and a non-operating asset, an operating liability and a non-operating obligation or liability, we talked about operating ratio analysis. So let's go ahead and start off with investments. And again, what I want to do is just kind of paint a broad picture. Please feel free to ask any questions that you have. So with investments, what we basically have is a case where we have this company. And this company is going to take excess cash and either invest in debt securities or in equity securities. Debt securities are typically going to be bonds. So when the company invests in bonds, what are they expecting to get? What's the one thing they're expecting to get when they invest in another company's bonds? Coupon. They're going to get interest rates, right? They're going to get interest payments at the coupon rate. What other cash flow is this company going to demand or expect to get later on in the life of the bond?
The maturity.
The maturity. Okay, so when the bond matures, they're going to get repaid their principal amount. Okay? When the company invests in another company's equity, another company's stock, And again, there's not a lot of companies that do this. Berkshire Hathaway was the one example that comes pretty immediately to mind because they have a lot of these investments. What sort of payments are they expecting? What sort of return are they going to be expecting to receive?
Dividends.
Perhaps a dividend. The difference with an equity investment is there's no guaranteed principal. These do not mature. Okay, stocks have technically until a company goes bankrupt or they trade below $1 a share for 30 straight days. Typically, they have an unlimited life. So there's no guaranteed payment at the end. Obviously, they can liquidate their position at any point in time. So we're going to kind of attack this two ways. When we talk about investments, we looked at it from this perspective, the company making the investment in another company's either debt securities or another company's equity securities. When we talk about bonds, we're going to look at it from over here. So here's the company that issued the debt. They're going to be paying these guys interest and principal. How do we account for that? How does that show up? And with respect to stockholders' equity, we're going to talk about the company that issues the stock that this other company may be buying or this other investor may be buying. So let's start off with the debt securities. Remember with debt securities, look this up because I think we'll want to keep this around for a little while. With debt securities, okay, and really with any of these investments, there's a couple key accounting issues we need to think about. Key issue number one. What amount are they shown at in the balance sheet? And really what this boils down to is, are these shown at cost, what we paid for them, or are they shown at fair value or market value? And you'll see the answer to that particular question is going to depend on the company's intention with respect to the security. The other issue we need to think about is, how do we account for changes in the market value? And very specifically, what we want to know here, what we want to think about here is, do they affect net income? Do they affect net income? Okay. So how do we answer that question? The answer to the question is going to depend on the company's intention with respect to the security. And we have three major types of securities that we talk about. One is called held to maturity. One is called available for sale. And the third is called a trading security. And the two key issues are, how do we show these on the balance sheet? And how do we account for changes in the market value? Because remember, these are publicly traded items. They're not as visible as stocks. They're not as popular in the press as stocks are. They are publicly traded items, and their market value fluctuates just like stocks do. So the easy one, trading securities. Trading securities, we show these at market value. So at the end of each period, we're going to increase or decrease the amount on our balance sheet for changes in market value. How do we handle changes in market value? They go on the income statement. Because they go on the income statement, they affect net income. And because they affect net income, where does net income show up on a balance sheet? Retained earnings. Okay. So these will affect retained earnings. Now, a trading security is a security where management's intention is to hold it for a short period of time, probably earn a little bit of extra interest than they could get in the bank account, maybe get a little bit more of a return in terms of if the market value goes up or down, but they're not planning on holding it to the end. They're parking cash in a security for a short period of time. This is strictly based on management's intention. And management says, hey, I'm only doing this for a short-term period of time. I'm doing this to get a little bit of a higher return. hope the market price goes up, but I'm not gonna probably be in this security for a long period of time. Management's intention. Held to maturity is the exact opposite situation. A held to maturity security is one, we're gonna keep it on our books at cost. I'm gonna put a little asterisk by here because technically it's something called amortized cost, but we can just call it cost. Changes in market value are not applicable because we don't write these securities up or down. We keep them in cost. Now, if we decide to sell them, you know, we may have a gain or a loss here. A held to maturity security, I always keep thinking that'd be a really cool country western song. It just never took off. I tried to get George Strait to sing it this summer. He kindly refused, okay? But a held to maturity security is one that management has the ability, the financial ability to hold it, and the intention to hold it until it matures. And the maturity is obviously going to depend on the nature of the security. If it's a 5-year treasury bond, it means management's going to hold on to it for 5 years. If it's a 30-year treasury, it's going to be 30 years. If it's a 50-year corporate bond, it means they're planning on holding it for 50 more years. Okay? But again, this is management's intention in terms of how they classify it. Finally, for available for sale, these are on our balance sheet at market value. Anytime we have to move something to market value, we got to figure out what are we going to do with the change in market value? Where is it going to show up? This is going to show up in accumulated other comprehensive income, which is a separate equity item on a company's balance sheet. So if I give you a scenario on an exam and ask you, hey, management's got some stuff that's trading securities, they're thinking of classifying it available for sale, and the security went up, would income be affected if they moved it from trading to available for sale? If they kept it at trading, they'd show it in the income statement, right? If they moved it available for sale, they would not show it in the income statement. It would be an accumulated comprehensive income. How does this decision affect stockholders' equity?
No.
Which we use in return on equity and all other kind of fund ratios.
They would go back to the same.
No effect, right? It's the same effect. It's just a different part of stockholders' equity. Instead of being retained earnings, it'd be an accumulated other comprehensive income. If I ask you on an exam, if a security is going down in value, what would management's incentive be? Where would they want to classify it? How would they want to classify it? Held to maturity. Because remember, they can keep it at cost. They don't have to recognize changes in market value. Okay, so again, that seems like a bit of a loophole. It seems like, gosh, we're giving management a lot of power. They can affect their balance sheet, they can affect their income statement, but the bottom line is it's got to pass muster with the auditor. So, any questions about debt securities? Yes, sir.
Question. When we talk about market securities, like the market value, do we see it at a quarterly basis or an annual basis or?
Good question. So the question is, with the market value, how do we do this? When the company does their 10Q, every quarter they would reevaluate it because they would show it on their quarterly financial statements. They wouldn't need to do it any more frequently than that. Okay.
For the trading securities, are the gains and losses, is that an other income that's not operating?
It can be shown in one of two ways. Very good question. Companies will show things different ways. Sometimes this will be shown as on a separate line item, and it would be something like, and this is a really important word here, unrealized gain or loss. We didn't sell the security. We haven't technically suffered the loss yet. You suffer the loss when you sell it at less than what you paid for. So you'd use the term unrealized. That would typically these aren't big enough to get their own line item on an income statement, so they usually would be lumped in with other income or loss. Any other questions? And by the way, realized gains and losses would be done the same way typically. Yeah.
So when you said that when we move from trading to AFS, we would affect net income because it would go down?
So what would happen, the way you would think about it is if it was classified as trading and you decided to move it here, it would affect your income.
Right.
Because under trading, you would show it in income. Here you would not.
Okay.
Okay? Here you would not. Now, again, if you're asking, does it affect stockholders' equity? The answer is no, because both of these are stockholders' equity. Anything from here to here would affect stockholders' equity. And one of the things that happened with Silicon Valley Bank is they had a bunch of stuff sitting up here. This stuff was declining in market value. It's like $15 billion decline in market value. If they had to show that in equity, they would have triggered all kind of warnings from the banking regulators because they didn't have enough equity. So there's a lot of people that were very suspicious about their motives. Nothing's been proven or not on that yet. Bottom line is the auditor agreed with the classification. It turned out they had to sell it. When they sold it, they had to suffer the losses. That's kind of an aside. Yeah, Devin.
Just reiterating what you said, just so I'm clear,
Sure.
is that we would want to move trading to hold to maturity if the market value is declining.
Correct.
And why would we move from available for sale to hold to maturity for the same reason?
That would help our equity.
Okay.
And it would also, if we thought the market was going to continue to decline, this would be better than this. Okay? Yeah. So there's a balance sheet effect here, and then there's a balance sheet effect two ways. It's the asset you report on the balance sheet.
Yeah.
There's the equity, whether it's through retained earnings or through this. And then there's also a potential income statement effect if you call something trading.
How frequently can management like change or like shift these things between each other?
Well, the glib answer is as long as, as many times as the auditor will let them. This is probably, if a company, especially after the thing with the banking industry happened, there's been a lot of audit alerts, a lot of audit pronouncements that basically said, hey, if you're getting people wanting to do this shift, basically make sure it's legitimate. Make sure there's a real reason for it. And there might be. I mean, you might have had the intention to do this, but now all of a sudden, because you have a cash flow crunch, you might need to sell it. Well, that would be pretty legitimate. But if all you're doing is kind of monkeying around with the numbers, it's probably not going to fly. Now, obviously, in class, I would have to tell you that they did change it or they didn't change it or they're thinking about changing it. But in the real world, this would be something, and especially if it has a pretty positive effect on the company's financials, the auditors are probably going to put a nix to it. If the auditors put a nix to it, it's not going to happen. Because then they get a bad audit opinion and the world falls apart. Got a lot of power. Adora.
So if you have something available for sale, right, and you want to report it next year, would that be plus or minus AOCI?
So repeat that again.
We're trying to report the value because we're holding a market value, right?
Right.
So for say 2022, we have it at 20 or 50, right? And we're trying to report the value for 2023. Would that value be whatever we had in 2022 plus or minus AOCI?
Yeah, good question. So basically what happens is it's kind of, your basis gets reset. Once you've written it to this level, your basis is reset. That becomes your new cost, so to speak.
So every year?
No, only if you're making that swap. Yeah, only if you're making that swap. Yes.
So if you're moving.
Like you wouldn't go back. Let's say you held them here for 5 years. You said, wow, I'm gonna push them back up
Oh,
here.
no, I'm not talking about
Okay.
pushing back.
Okay.
You're holding it in there.
Yeah, you're good. Okay,
Okay.
yes.
So if you are moving a security from trading to available for sale, then the net income goes down, then that affects the ROE. So that will affect the investment decisions, right?
It would, yeah. Mhm.
So the market will look at the ROE.
Yeah.
So-
And by the way, these shifts don't happen a whole lot. Now, I know I gave you all an article, Wall Street Journal article that talked about Charles Schwab and some of the other large banks that had moved different parts of their securities. But yeah, it would have an impact, sure. Because if you decide, let's say you decide on November 1st, because your stock, the thing you invested in took a pretty big hit. If you decided November 1st to move it over, you'd move it over at the value on November 1st. Okay, but you wouldn't have to take it to income because of it would be now, anything happen after that would not go in income. But again, let's not get too tied up into this because it doesn't happen a whole lot. The whole idea behind this though is, and really the idea here, if you hold this to the end, and you saw this when we did the bond example, if you hold this to the end, the cost is going to be what it's worth at the end. Because that's just that's how the market's going to work. Because the market's going to know, hey, you get $750 at the end of year 3. I think that's the example I used in the bonds. Okay, so the market's going to price that at $750. So you really won't have any gain or loss, if you hold it to the end. Remember, all this is based on is the real goofy key word here is intent, management's intention. And who knows what management's really thinking? Okay. Good questions. Yeah, Josh.
So for like the unrealized gains, I know there's been like talk about like taxing those, right?
No taxes on that.
Right,
You don't tax until you sell.
okay.
Yeah, so there's no tax impact to this right now whatsoever. Good question. Other stuff. All right, let's move into the equity side of stuff. So now, again, think about what we're doing. We're investing in another company's stock. This is even more unusual than investing in debt. The example we used, because there's so much of it, was Berkshire. But the way we account for the investment in another company's stock is really going to depend on the level of ownership we have and the reason for the investment. So if we think about company stock, you can own anywhere between 0% of the shares. And if we have 0%, we got nothing to talk about. There's no investment. Or you can own 100%. So one cutoff, and this cutoff is about 20%. And I say about 20% because the accounting standards don't give you a precise number. But what they tell you is once your investment hits a certain level, and this is presumed, if you remember, Berkshire Hathaway basically said, we have a 22% ownership in American Express. But we are agreed to vote for the board, with the board, I'm sorry, but we don't intend on exerting influence. So we're going to account for it under this other way. So Berkshire Hathaway is probably the closest to putting something in writing that says 20% is a big deal. Once you hit this, we have what we call significant influence. As you all know, Coke and Pepsi have several of these things. And you may remember some of them kind of danced around that 20% level, 19, 22, 20, 23. I think I got those numbers right. The idea here is you're not buying this investment to get this dividend. And you're not buying this investment to sell it later in an appreciated price. You might, but that's not your intention. Right now, your intention is to align a partnership. And Coke and Pepsi had some really good examples of this, okay? Coca-Cola has these partnerships with their bottlers because they want a place to sell their concentrate. They have this relationship with, God, I'm answering the case for you. What the heck am I doing? Okay, that's okay. Y'all deserve something for being here today. I want to answer question number 4. Okay, Coca-Cola has this relationship with Monster because they want to market the products or whatever. So there's a different objective here. We have significant influence. Then we get to 50%. And once you have 50%, it's technically 50% plus 1 share, you have control. So the way we account for these, between 0 and 20, we show these investments at their market value. And we take any changes in market value to the income statement. We basically treat these just like we treated trading securities. Once we get between 20 and 30, and by the way, this is called a passive investment. It's not passive because we don't care. It's passive because we don't intend to dictate policy. We don't intend to operate it. We don't intend to manage it or control it. Essentially, what we're doing here is putting money into this investment in order to earn a higher return than it's sitting in the bank. And that return can include a dividend, and that return can include selling it for a higher price later in the future. Once we get into this realm, okay, the way we account for this is a little funny. we're gonna take our cost. We're gonna increase this investment for our share of their net income. So if they have income of $100, we own 30%, we're gonna increase our investment by $30. We're then gonna reduce our investment by our share of their dividend. Because we kind of think about this as they're taking this income that we recognized and they're giving it back to us in the form of a dividend. This is called the equity method. This thing will show up in the balance sheet. It's a non-current asset. Because again, it's not going to turn into cash within a year. We're not going to sell it. And it'll use some language like investment in equity affiliate, investment in non-consolidated affiliate, something like that. It'll have some language like that. And it'll usually use the word affiliate, okay? Because it means, hey, we're affiliated with this thing. We don't own it. We have a pretty serious interest in it. This share of our net income will go to the income statement. This one's a little different because it has a little bit more of a strategic nature to it. It doesn't typically get merged in with other income. It could, but it gets shown as a separate line item. You might say something like income from equity affiliate, income from equity investment, income from non-consolidated affiliate, something like that. And looking at Coke and Pepsi, you see that they'd use different language to really kind of say the same thing, which is a really good lesson. Financial statements don't have to use uniform language. Companies will call different things, but both of these companies have investments that they have where they have between 20 and 50%. Okay, so this one affects the income statement and it affects the balance sheet as well. Questions there? Yes, sir.
This would be at cost.
I'm sorry?
The value of this in the balance sheet would be at cost and not
Value will
market
be
value.
cost plus our share of the income minus our share of their dividend. So we adjust our investment each year for the money they make and the dividend they pay.
But fluctuations in share price, we don't.
Don't mess with it because it's not relevant to us. We're not selling. It's kind of like held to maturity in a way. Now, we're not getting, A, this doesn't mature, and B, we're not saying we're gonna hold it forever. The only time we do anything with the share price is if it's way less than this value. Then it's kind of like PP&E, it's like goodwill, it's like inventory. We take a write down to reflect the reduction in value. But the reduction in value has to be something that's permanent. It's not a temporary thing where it dips below 1 year, for instance. It usually has to be pretty serious, pretty significant.
There would
Yeah.
be, if there's a net loss,
I'm sorry?
if there's a net loss.
Net loss, it would reduce our investment. Yeah. So we might get a double whammy. We reduce the investment and we get a dividend. It's gonna make our investment get written down. Now, the good news from the company standpoint, it affects total assets, but it doesn't affect current assets because this is a non-current asset. So it's not gonna affect your current ratio or anything like that.
This would also be an unrealized gain or loss.
No, it's unrealized gain or loss typically means you have something that's on your balance sheet for a value and the market value is higher or lower. We're not looking at market value here. This is going to their income statement, literally taking our percentage ownership of their income. So for all those bottlers Coca-Cola had, if those bottlers were profitable, Coke would show 20% or so of that income in their investment account. They'd also show that 20% or so on their income statement. And then they subtract out any dividends they got. And I can't remember if the bottlers pay dividends or not. Okay? All right, last one, control. Once you get 50%, you basically prepare consolidated financial statements. Take the assets of what you own, add them to yours, come up with a total. Take the revenues and expenses of what you own, add them to yours, you get a total. The only really trick here is if it's less than 100%, you'll have a non-controlling thing. And this non-controlling thing will be equity and net income. And all you're doing is saying, hey, I own more than 50% of something, but I don't own the whole thing. Okay, so just kind of broad overview here. And notice the issues, the amount shown on the balance sheet. We talked about it for debt securities. I've erased it. We talked about it for equity securities at market value, at this kind of weird calculation. We prepare consolidated where we add them together. We also talk about how do we handle changes in market value. Over here, they go to the income statement. We do not do anything with them here. We do not do anything with them here. So any questions about investments before we move on? Yeah, Dora.
So the non-controlling, where you say equity and net income,
Uh-huh.
if we're not reporting, why do we have?
Because we don't, because just to give you a quick example of how that works. And I'll show you the balance sheet, the income statement works the same way. Okay. Here's company A's balance sheet. Here's company B's balance sheet. Okay, if we buy 100%, A buys all of the stock of B. Okay, they show assets of 110, liabilities of 76, equity of 34. If A buys 90% of B. Now, your first instinct is, okay, easy, take 90% of this, take 90% of that, take 90% of that. But that's not how it works. If it were that easy, we wouldn't have to have accounting people to tell us about it and earn our keep, so to speak. We're gonna say, look, we own 90%. We control these assets. We're gonna put them all on our balance sheet. We own 90%. It's more than 50. We control, if you will, all these liabilities. The equity is a little different. What we're gonna do with the equity is we say, all of this belongs to our shareholders. And 90% of this belongs to our shareholders. So we'll show equity of this plus 90% of this. And then we're gonna say, this thing B has $4 of equity. 10% of that belongs to other shareholders. And this is gonna be in the equity section, usually using a word non-controlling in it. Okay? So that's what it is.
This might be stupid. How is an investment, like if I have 100% investment, how is that different than an acquisition?
How's it different than what?
An acquisition?
It is an acquisition.
Oh,
You would have basically acquired it.
that's,
Because remember, when you get that balance sheet at the top, it says blank company consolidated financial statements or consolidated balance sheet. So consolidated means it's everything that gets owned. So it's Walmart, it's Sam's, it's Walmart International. It's anything that Walmart owns more than 50% of.
I guess just building off that, conceptually, I'm confused, you know, like if we're assuming this is Walmart, Walmart doesn't own those 30 shares, their shareholders own those 30 shares, so why are we treating it differently for the?
Because those are Walmart shareholders. Okay, this is held by non-Walmart shareholders.
Okay,
Those are Walmart shareholders who own that 90%. You're right, Walmart doesn't own it.
When we talk about,
And by the way, when I say that a company by itself is nothing. It's the shareholders. They're the owners. Yeah.
Just to clarify Allison's point, when we talk about mergers and acquisitions, the acquisition is greater than 50%, mergers is also greater than 50%, or merger lies between 20-50 or something.
So technically, in the media, when you talk about a merger, they use the word merger, meaning two companies are coming together basically as equals. They're getting together. The new board of directors is going to have 5 directors from here and 5 from here. The executive team is going to have people from here and people from here. So the word merger tends to be
A new company coming.
a joining of equals. An acquisition means I'm buying you. I'm gonna have the board. I'm gonna have the executive team. Okay, so even though those get used interchangeably, they really tend to be, they're accounted for exactly the same way.
So when a merger happens, what would, like, it would be like a new company and then there would be a new balance sheet, or?
There's always gonna be a new balance sheet. Okay, there's always, because you're gonna be putting these two things together. There'll always be a new balance sheet. But again, it really is more along the lines of, is this a joining of equals? Or is this one company going out and buying another? When Microsoft bought Activision Blizzard, that is not a merger, that's an acquisition. Now, again, at one time, those terms had, the meaning in those terms was very important. It isn't as much anymore.
Where does goodwill fall into this?
Goodwill would fall into this if they paid more than $4 for this. Goodwill would then be brought onto their books as an asset and would be part of the combined balance sheet.
And
Nice little trick for the exam. Thank you. You guys are giving me some great, these ideas are phenomenal.
so I
Yeah.
was gonna ask about the goodwill as well. Would you only see that, so with Activision Blizzard, would you only see the goodwill reflected on Microsoft for that year that it occurs? And then everything for Activision Blizzard is rolled up for the years following?
No, it would stay, they would be brought on the balance sheet the year it got acquired, and assuming it still had the value, it would stay on there forever,
Under good,
under goodwill. Yeah, under goodwill. So if you see goodwill on a balance sheet, so think back to the exam that you just took. Remember that goodwill stayed the same, it went down from 22 to 23 and or 21 to 22 and then up, then stayed the same. It stayed the same because there wasn't any impairment, but it's the same goodwill from a previous acquisition.
so how is this different than goodwill?
It's goodwill happens when you make an acquisition and you pay more than that. I assume we just paid that. I didn't want to get goodwill involved.
Understood. Okay,
Unless you'd like me to.
no, I thank you. Thanks for the clarification.
Taking an example of that, let's say I paid 5 for the 4.
Yeah.
And the non-controlling is still 0.4, so 1.4 would be the good.
No, if you paid 5 for the 4,
No, but I don't, like, I still own 90% of the company only.
that's what you look like. And then you'd have to, you would have other things coming on the books to offset that goodwill. It will work, but let's not complicate this beyond this, okay? I'll be happy to do that after class with you, but basically you would bring the goodwill on if you did, but let's not worry about that. And actually, if you paid 5 for 4, that'd be 101, not 105. Okay? All right. Let's now go to, we look up there, let's go to the bonds issue. With bonds, really what we talked about in long-term debt, we really hit on 3 points. Point number 1 was the selling price of bonds. Point number 2, does a company have too much debt? And point number 3, will the company generate enough of some sort of cash flow to meet their interest payments? Okay? So those are really the 3 things we hit on. With respect to bonds, remember some of the dynamics of a bond. Bonds have a face or principal value. And this is just the amount that the company is agreeing to pay the investor when the bond matures. Remember, bonds are different than stocks. Bonds actually have a fixed life. Okay, a fixed life, they mature. There's the coupon interest rate. There's the maturity date. And even though this is pretty standard in the bond industry, if you will, the payment frequency. And usually it's semi-annually, every 6 months. So the first thing to know about bonds and pricing bonds is when you issue the bonds, you basically are contractually obligated for your cash flows. Every investor knows exactly what their cash flow would be if they hold this bond. Okay, it's going to be this principal. And I think we did an example. We did an example in class where we did a $750 bond. Again, it could be 750,000 or million or whatever denomination you'd like. And we're also guaranteeing interest payments based on this principal, based on this rate, and based on this payment frequency. And these were, I believe, $15 each. So key thing number one, the cash payments are fixed. They're part of the bond contract. And short of this company going into bankruptcy, they are guaranteeing those payments to the investors. Now, remember, if a company does go into bankruptcy, and you remember the AMC example where they have different tiers of bonds. So they have first lien bonds. They get the first crack at the assets. Then the second lien get crack. Then the senior lien gets crack at the assets. Usually you think senior, that's good. Well, they're number 3 in line. And then everybody else has to wait. But all these people get paid back before any stockholders do, because it's debt, and debt takes precedence in liquidation. We hope that never happens. It does from time to time. What happens then is based on market conditions, based on, and I think the rate we use is 4% in our example, based on market conditions, based on company-specific risks, the investor is going to look at this string of cash flows, and they're going to say, what return do I want? And again, they're bidding with other people for these bonds, so they can't get outrageous. Oh, I want 25% return on my deal. So the riskier the situation is, if treasury bills are returning 5%, investors are going to want more than that, because these are riskier than treasury bills. The US can print money to cover treasury bills. This company cannot. If treasury bills are 1%, these investors, if this company isn't very risky, they might be willing to settle for 3. Okay. So based on all that, these investors are going to come up with some desired return. Which we call yield. They're going to discount all this stuff back. And that's what the bonds are going to sell for. Now, these are bunches of investors in a marketplace. Okay, and what will happen is, just like any sort of commodity that's in an auction, you know, the prices are going to vary, they're going to fluctuate, but the bonds will sell for the present value of these cash flows based on an investor's desired return. Remember, we talked about 3 different kind of conditions. Bonds will sell for a premium if the coupon rate is greater than the yield. Investors would want to pay more for these bonds because they're getting a very attractive interest rate. The market rate may be 2. These bonds pay 4. They'll sell at a premium. Bonds will sell at a discount if the coupon rate is less than the yield. These bonds have a 3% coupon rate. The market rate for US Treasuries is 5%. How do I entice an investor to do this? Well, pay me $700 for something that I'll give them $750 for at the end of the life of the bonds. We talked about how the bonds get priced. We talked about premiums and discounts. I'm not gonna have you go through and do amortization tables on a final exam. I want you to conceptually know what it means when a bond sells for a premium or a discount. Okay? So any questions about bonds and selling prices? Now, obviously, in a perfect world, we could know for certain when we go to market what this is gonna be, but we don't. We gotta file all this paperwork early, we gotta get all approved. We may file this paperwork on March 10th, 2020, and our bonds go to market April 1st of 2020. Something happened between March 10th and April 1st, 2020. Yeah, it's not a perfect world. Questions about selling prices? So kind of understand what it means to sell at a premium or discount, understand these relationships, understand that the cash flows are dictated and are not affected one iota by the selling price of the bonds. Cash flows are exactly the same. The company knows what it's up against, the investors know what they're getting. Same in a question.
Yeah, if the coupon rate is equal to the yield, is that at par?
That's at par, yeah, that's at par. And that one's so boring, I'm not gonna insult your intelligence by giving you a par value. It's too easy. You guys are capable of so much more than that. Okay? With respect to ratios, again, just like the midterm, I'll give you a ratio sheet. With debt, what we're gonna look at is some measure of debt over something. How does our debt relate to something? With respect to interest, we're gonna look at ratios that have something over our interest expense. Remember with that, in the world, in the real world, you can use so many different measures. You can use debt to liabilities. You can use, if you wanted to, you could use something like debt to goodwill, which makes no sense, but you can calculate it and come up with a ratio that means nothing. The ones we typically look at are debt to equity and debt to EBITDA. But that, so you know, it's two different things. If you remember, there was an article I gave you all on Carnival Cruise Lines, and the fact they weren't reinstating their dividend. And one of the explanations was they wanted to get this ratio back in shape, wanted to pay down some debt because their debt had slid to non-investment grade. They want to get it back up to investment grade. With respect to interest, we kind of look at two things. We looked at earnings before interest and taxes over interest. We called that ratio times interest earned. That's a fairly common ratio that gets used just about by everybody. The other one that gets used, since a 4-letter acronym is kind of fun, 6-letter acronym is even more fun. We'll go with EBITDA here. If you are a lender, you're thinking about loaning to this company, would you want this to be high or low? I hear a low. Anyone disagree with that? We want it to be low, because it means they don't have a lot of debt. Think about AMC, they had all that debt. They had that first lien, the second lien, the senior, then the other stuff. If you loan them money, you're getting in line. Okay? When you look at this ratio, and what this one is, we call these coverage ratios. These measure how good we are or how able we are to meet our interest payments. Because if we think about it, for a lot of investors who aren't going to hold these bonds until the very end, they really just care about this $15. Let's make sure I can get that every 6 months. This is someone else's problem because I'm going to sell the bond. Okay? Do you want to have high or low interest expense if you're an investor in bonds? If you're a lender, high or low interest expense?
Oh,
Okay. I think you're answering the ratio question.
Yeah.
You want low interest expense, which means a high ratio. And it's not a perfect correlation because they consider other things. But these are two types of things that credit rating agencies look at when they're giving credit ratings. You know, we showed you some examples and we showed you, that even though Alphabet / Google has really, really good ratios, they're still just AA. AA is really good. Only 2 companies have AAA. Okay. And we also talked about how, and that Wall Street article talked about it, usually takes a few years for a rating agency to move something unless it's a pretty dramatic change. Usually they'll move something down much easier than they'll move it up. But that's just kind of anecdotal. Any questions about?
Just about that last one, this is actually a real world thing, because I had read about Topgolf, they're in a bit of a sticky situation right now, and their rating went down to B+, and the article made it seem like this is like a travesty, but I thought that that's sort of in the middle, right, or that's not that bad.
Well, it's better in Carnival and AMC. Anytime it goes down, there's always a little bit of a cause of concern.
Mhm.
I mean, it was a big stink for 2 years when ExxonMobil lost their AAA, because they were just uber, they should be. I mean, when you're number 3 in the world in something, you wanna kind of keep that little distinction, right?
Yeah.
Now, what happens though, when your credit ratings go down,
Mhm.
what happens is your interest costs will go up, the rates people will charge you will go up. The loan terms won't be as favorable as they would have been if you were AAA. There's no real evidence that shows it affects stock prices too much,
Mhm.
but it does affect some of the prices of your debt out there. Okay? Because a ratings downgrade, which is what that would be referred to, is a pretty public event.
Mhm.
It's a pretty public event. But yeah, and again, is it an overreaction? Maybe. I haven't looked at their financial statements, so I have no idea if that was warranted or not, if they've deteriorated. I just don't know what it is.
So you mentioned for the debt over X ratios that lenders want that low. Don't owners want it higher though? Because it's showing you're not, I mean, especially if it's debt to equity, you're not using as much equity, you're using more debt. So is there normally like a conflict there, like trying to?
Yeah,
balance it?
there is. There's no question. Because remember, when we talked about ROE, one of the things we looked at was financial leverage. And we said, as long as you're borrowing, as long as this is lower than what you could earn with the money by putting it back into your business, a stockholder would want this to be high. But a lender does not. Lenders don't care about that. Lenders want to know that, hey, there's not $4.6 billion owed to other people. Now, remember the other thing about debt in general is, and it's really, it can get kind of important, depending on how companies structure their things. Remember in their footnotes, they have to show a 5-year maturity of their debt. So you can actually look in the footnote and see how much debt is due in each of the next 5 years. And remember that AMC had this really, really big chunk due in 26, but they refinanced it and kind of kicked it down to 29. And again, was that a good deal for them or not? I'm sure they had to pay a little bit higher interest rate to get that done. I'm sure they had to take no lender's gonna say, yeah, just take 3 more years. You're good. Okay? Sarah's not gonna walk in here and say, pay your tuition to us in 2 years, unless she says, okay, well, we're gonna charge you 10% interest a year to do that or whatever. She won't do that deal. We can't do that deal. It's illegal. But no one's just gonna let them do that. Okay? Long-term liabilities. It's really gonna be sad. In 2 hours, I'm gonna get done what we took like 6 classes to do. But it was the fun along the way, the journey. That's what we call it, the journey. Okay, questions about long-term liabilities? Those are again the key points. Okay, let's talk about stockholders' equity. And again, you see where we are up here. We're still in this phase where we're getting funds, in this case, from that bottom group, shareholders. You'll see there's cash payments that go from shareholders to the company, cash payments that go from company to shareholders. To give you a little schematic, here's the company. Here are shareholders. We talked about a lot of different transactions. So one transaction we talked about is the company issues shares to the stockholders in exchange for cash. Remember, when we have that, we allocate the proceeds between the common stock account and the additional paid-in capital. Remember, the common stock, we show the par value, meaningless number, but we do show it, everybody shows it. Then from time to time, the company will decide, hey, I want to go back and buy those shares. And in exchange for those shares, I'm going to give cash to the shareholders. We call this treasury. Treasury stock. And companies buy their shares back for a number of different reasons. One reason, they may think it's undervalued in the marketplace. They may view it as a good investment. I can buy it for $80 a share, and in a couple of months, I might be able to sell it for 110. It's a pretty good return. Now, remember, if they do that, they are going to get economic gain, but they can't show it as income because you can't show income dealing with your owners. So it wouldn't be shown as income. Okay. Then we talked about the company might make net income. Let's assume net income and not net loss. I kind of like positive in the day. So money kind of comes into the company through net income. The company may have things that change in value, but because the accounting rules say don't include them in income, we have to show those separately. They may have some AOC items, or AOCI items. So they have additional value there. And finally, the company may pay a dividend to shareholders. Those are basically the transactions. Now, when you look at this and think about this, the easiest way to remember things is if cash or value is coming to the company, like when we sell stock, like when we earn net income, like when we have AOCI. And oh, by the way, we can reissue this treasury stock if we decide to. When money comes in or value comes in, that makes stockholders' equity go up. When money goes out to shareholders or value goes out to shareholders, like when we buy their stock and put it in treasury, like when we pay them a dividend, that's going to decrease stockholders' equity. And if you're super confused about where something goes in stockholders' equity, where do you put it?
AOCI?
Where?
AOCI?
Your life raft, your accounting life raft, additional paid-in capital. Okay, if you're super confused, additional paid-in capital. They don't on the final exam dump everything in additional paid-in capital, because I can assure you that's not going to be a good day for you. Okay? Those are the basic transactions we have. Stockholders' equity. So we spent some time talking about that. We talked about stock splits. Remember, all stock splits do is, again, a stock split can work both ways. You got a stock split that puts more shares out there or fewer shares out there. Some company did a 15-for-1 yesterday. I can't remember the name. I read about it this morning. Anyway, someone did a 15-for-1 stock split. Yes, it's a company that I've actually heard of and I have bought stuff there. I can't remember the name of it. Anyway, when a stock split happens, you're not creating any new value. Typically, you split your stock when the shares become trading at a fairly high level and it becomes cost prohibitive for people to buy your stock. I think the example we used for that was Chipotle. They did a 50-for-1 stock split. You can do a reverse split. And typically you do a reverse split when your stock is trading at a really low value and you want it to be trading at a higher value. WeWork was the example we did for that. NVIDIA also did a stock split pretty recently. Okay, they did a 10-for-1. Right, so with respect to stockholders' equity, when you buy a stock, how do you make money? Two ways, one of which I've got on the board. Dividends. What's the other way you make money? Buy low, sell high. Stock price appreciation. So we talked about two sets of ratios that evaluate those things. With respect to stock price appreciation, one set of ratios takes the price of a company's stock or the market value and puts it in perspective of something else. You notice I'm using a lot of these X's here. Because what we're trying to do is say, what is the relationship between the price of a company's stock and something? The higher this is, it does not mean the stock is overpriced. It does not mean the stock will not appreciate. It does not mean the stock is a good or a bad value. All it means is you're paying more per dollar of something if this number's high. So if you pay $200 a square foot for a house, is that expensive? Depends, right? Who knows? But it's more than if you pay $190. The $190 house may be terrible. The $200 house may be great. We don't know. This is the same way. So you can't really say that it's a good buy or a bad buy. You can say it's more expensive per square foot. Here, we're going to look at two things. We're going to look at the market to book ratio, which is the market cap of the stock divided by basically equity. Because that's the book value of assets. Assets minus liability. The more common ratio we look at is the price of the stock divided by the earnings per share. It's called the price earnings ratio. And we showed a bunch of different examples. We showed how Berkshire Hathaway, even though it's over $600,000 a share when I did that table, was the PE ratio was 12, which was the same as Halliburton, which was the same as something else. I mean, it just told you, yeah, 605,000 is more than whatever Halliburton pays for, but based on the dollar of earnings you're getting, which is important because that's what they can use to pay a dividend to you. It was the same. The other thing we want to look at is dividends. And we want to look at dividends in relation to something. So two ways we want to think about dividends. You pluck down $10 to buy a share of stock. They pay you $1 dividend. Your dividend yield, or your yield on this investment is 10%. So dividend yield is going to be the dividend per share divided by the price per share. The other way to think about a dividend, the company has X dollars of earnings per share. What percentage of that do they pay out to their investors? This is the dividend payout ratio. Dividends aren't good or bad. Okay, that depends on your investment objective. Some people like the notion of a company that doesn't pay their dividends. Why? They don't have to take that money up here, give it to their shareholders. They can take that money and invest it back in the company and develop new products, new services. Apple never paid a dividend until Steve Jobs passed away. And Steve Jobs says, as long as his exact quote was, as long as I'm alive, we will never pay a dividend. We will never repurchase our shares. Okay, when Tim Cook took over, they started paying dividends and started repurchasing their shares. It was just Steve Jobs' fault. He said the money needs to be developing new products because that's where the value is. Your stock price is gonna soar. You can laugh at your friends getting the dividends. He didn't really say that, but he kind of said that, right? Okay, so those are the two things we want to think about when we're looking at stock. And what they do is they answer these questions. Okay, how expensive is it? And will we get a dividend? Now, there's one last ratio that puts all of this stuff together. And what it does, called total shareholder return. Takes the ending stock price minus the beginning stock price. So how much the stock, excuse me, how much the stock appreciated or declined in value. It adds the dividend. We divide that by the beginning price. So beginning price was $10. Ending price was 15. They paid $1 of dividends. Your shareholder return would be 60%. $5 appreciation in stock price, $1 of dividends divided by the $10 investment. And obviously that can go the other direction, as we saw with some of the banks. We did the JP Morgan example. Okay. A vote. 10-minute break, or I can finish what I think I need to finish in 15 minutes and hang around and answer Q&A. Keep going? Y'all had a way longer day than I have, so I'm giving you options. And you'll know, this is the only democracy we'll ever have in this class, so enjoy it while you've got it. Keep going? All right, well, you're just saying keep going because you're on a high right now. You're free,
right.
walk out that door, it'll be like Field of Dreams. You'll just turn into a tired person and energize, you're excited. Okay. All right, last thing we did is, well, yesterday. And what we did was we looked at ROE, which we talked about way back at the beginning of the semester. Which is just net income divided by average equity. And what we did was we took this and wanted to break it into two pieces. Piece number one, how did we do with respect to our operations? How did Walmart do in terms of their profitability based on using their assets, their stores, their delivery equipment, all their assets that they have, all the assets that they own? How did they do with those assets in generating money from selling products and services to customers, paying their employees, paying their utilities, paying their rent, depreciating all those operating costs? Then what we did was said, there's another part of the company as well. This company's Walmart will have some cash on hand. It's sitting in a bank. It is not invested in their operations. No one's ever gonna run their account down to zero. Okay, there's always gonna be some cash sitting around. They may have some investments. Again, they're putting it into investments. Think back to what we started today with when we talked about investing in debt and equity securities to earn hopefully a higher return. But again, this money, instead of being in some other company's stock, or instead of being in treasury bonds, or instead of being in something like that, this other money could be invested back in opening up new stores, generating more operating profit. Then we want to say, okay, Walmart is also taking on some debt. They've borrowed money. Because they borrowed this money, they have an expense tied to it called interest. This cash and these investments, they have revenues tied into this. Interest revenues, and if they owed stock, they might get a dividend from that company. So basically what we want to do is we want to see how have they done down here. This is going to be the non-operating piece. Now, I kind of warned you all yesterday that you're going to see lots and lots of acronyms. You're going to see lots and lots of formulas. But conceptually, what we want to do is we want to say, if they're borrowing, when we net all this stuff together, if they're borrowing at X%, are they at least earning higher than that? And if they are, we're going to be happy because it means they've done a good job. Could they do better? Sure. Okay, but at least they're earning what they're paying in interest when we net all that stuff together. If they're not, basically what it means is we're borrowing money at a higher rate than we can use to generate this. So a couple of steps that we do. We're going to go to the balance sheet. Classify assets and liabilities as either operating or non-operating. These are essentially the non-operating ones. Everything else is operating. Now, there's some really weird examples that some people talk about. You know, there's these derivative contracts, there's these other things. If it's really, really weird, it's probably going to be down here. But for the basic stuff, which is what we're going to do just to understand this, essentially anything that's not here is going to be operating. So this is going to include everything from an account receivable to a goodwill and everything in between. The non-operating, the liability side is going to be, is going to be any sort of, the operating side rather, accounts payable, accrued payables, anything other than debt sorts of items. We're going to go to the income statement and do the same thing. We're going to look at operating and non-operating revenues, operating, non-operating expenses. And most of the time, if you grab that operating profit line off the income statement, that's a great place to start. We do all this stuff net of taxes. You'll have the formulas. So here's what we're going to do. ROE, we're going to break it down into, okay, NOPAT, net operating profit after taxes. Remember this little part, after taxes. Divided by average net operating assets. That's basically return on net operating assets. It reads a lot like all of our other returns. Return on equity. For every dollar of equity, how much income? For every dollar of assets, return on assets. Every dollar of assets, how much income? For every dollar of operating assets, how much operating profit, operating income? Same thing. Okay? This piece tells us how we did with operations. So we think about the cost of our stores, the cost of our trucks, the money we've invested in our furnishings inside the stores, all those other, the inventory, all those other things. How good did we do? Okay. Then what we're going to do is take a look at these non-operating things. I'm gonna leave a little room here. Now let me do this. Now let me I'll break it out. That's the easiest way to do it. Leave a little room here, leave a little room here. What we're now going to do is say, okay, let's look at this non-operating stuff. Okay, we have all this debt. We have this cost associated with that debt. We're gonna offset the cash against that, because you could use that cash and pay back the debt. That's your net debt. We also have some revenues because we hold this cash that we can offset against this stuff. But most companies are gonna have net operating expenses, net non-operating expenses, I'm sorry, NNE. Based on their net non-operating obligations, NNO. I don't know why they don't use liabilities in the book. They use obligations, just kind of humor me, but obligations, liabilities, kind of means the same thing. We affectionately refer to this as NNEP. Net non-operating expense percentage. And by the way, net means net of taxes. We then take the difference between that and our NOA. Because that answers the fundamental question we had. It's costing us 10% net to borrow money. We can go out and earn 18% if we invest that money in operating assets. We should do more. It's costing us 10% to borrow that money. We can earn 6% by buying more net and operating assets. I'm gonna do it, okay? This is called the spread. And it's just a difference between what we can earn with money and what we pay for money. If you think about it, they're very, very 30,000-foot level. Then we're gonna multiply that by the way, this is average. My bad leaving that out. Average net non-operating obligations divided by average equity, which we call FLEV, kind of a leverage sort of a deal. And all this piece is going to do together is tell you about how we do with non-operating stuff. So we just kind of walk through things. ROE is going to be better when this is high, because we're generating more profit for every dollar of assets we have. And those assets can come from shareholders or lenders. Down here, as this is higher, you can see because we're adding it in, ROE is going to be higher. The bigger the spread, the better off we are. And look what happens if we have this really, really big spread, and we got this really huge amount of liabilities. We're borrowing lots of money, really, really cheap, and earning a good return. That's your dream. Hopefully we have better dreams than that, but that's my dream as an accounting person. I love high ROE. It's cool. Okay. But think about the other side. What happens if we have this really high? This is going to be negative. What if this is really high? Big negative. It's going to kill our ROE. Okay. And again, if this is good and this is low, it's still okay. But what if this is really good and this is low? What might you advise the company to do? Borrow more money. Borrow more money. Now, this is assuming we can borrow it at kind of the same cost, right? You will get used to the calculations. Okay? But conceptually, try to understand what we're doing here. What we're doing here is we're saying we can be profitable two ways. Way number one, we can be profitable by doing our normal main line of business. Number two, we can be profitable because in doing that main line of business, RNOA, we're able to get money real cheap and get lots of it. So I think Ryan, I had a question?
Yeah, because I was a bit confused by this on the quiz online, where the NCIR, that's just,
So I told you we're gonna ignore that and just use
Oh.
consolidated numbers.
okay,
Yeah, because that candidly, that adds a wrinkle to things. And the NCIR was one because they didn't have any non-controlling, so it didn't affect anything really.
Mhm.
That adds a wrinkle that just is totally unnecessary.
Okay. all right,
And I thought, there's a lot of research that shows that sensory overload is reached with 8 acronyms. Couldn't give you a ninth one.
all right.
Nobody. No one deserves a ninth acronym. And by the way, I'll announce this to the class tomorrow. One of the things I hated about that quiz is there was a lot of things I hated too. If you made a mistake, it followed you all the way through. So you may notice I changed your grades. Maybe you didn't, I did. Yesterday, when I went back and looked at it, I changed your grades. So if you just followed the same mistake through, I went back and retroactively gave you points. So no one in here has a lower grade than they started with. I don't like that. And there was a second way you could have done the calculation, and if you did it the second way, I gave you credit for that too. So I went back and hand graded that one kind of multi-part problem where the mistake up here kind of haunted you down the line. Okay, so your quiz grade should look different than it did. It might look different than it did if you had one, if you just made one isolated mistake and nothing else, then it didn't change anything. But I think probably 80% of the grades were raised a bit just because of that. So if you look at your quiz grade and it's different, that's why. I've never had someone appeal raising the grade. But I'm all ears if you're interested.
All right, almost got mine dropped on my Shetty exams the other day, because his went up. I had to get mine brought down.
Well, that's, Shetty has that whole mean thing he's got to deal with, right? Since the stat guys. Okay, yes.
I just had a question regarding ROE.
Mhm.
So from an exam perspective, like how are we supposed to best prepare for the exam? Like just understand the ratios and how it impacts the company?
Yeah, and I might give you a balance sheet and ask you to first of all, a pretty good way of thinking about this, part 4 of the Coca-Cola Pepsi saga will actually have you do some of this. Okay, now on an exam, because there's a bit of a time crunch, I don't like to have lots and lots of grinding calculations. So once you're spending a half an hour calculating something, and if it doesn't quite balance out, you freak and you lose track of the rest of the exam. But the Coca-Cola case would be a good way to kind of test yourself out on this. Yeah, and basically, if you think about it soup to nuts, what could I do? I could give you a balance sheet and income statement and say, do this. So you have to, but think about all the calculations you'd have to make, right? You'd have to calculate your net operating assets and your net non-operating obligations and your NOPAT and your NNE. Now, once you calculate, basically, if we really think about the calculations that drive all of this stuff, 1, 2, 3. And I'm talking about kind of new calculations. There's really 4 things. This is already taken care of here. This is taken care of over here. You already know what that is. So really, it's just 4 things. Now, granted, to get this thing, you got to wade through 20 balance sheet items, maybe. Yeah, okay. Okay. I will be happy to hang around, answer questions. If you don't have any more formal questions, we will see you tomorrow. You guys have a great day.